Hello, everyone, and thank you for joining me today for our January 2025 market update. I'm Michael Kolb, CFP with Evergreen Wealth Solutions, Director of Planning and Investments. We've got a lot to cover, so let's dive right in. January was a really strong month for markets, rebounding after kind of a mixed December. The S&P 500 was up 2.78%. The Dow Jones was up 4.78%. And the tech-heavy NASDAQ still managed a 1.66% gain, even despite some headwinds. This rally was fueled by strong corporate earnings, and as of early February, the S&P 500 had reported earnings growth of 10.1%, which is significantly outpacing the initial estimates of 7.3%. Strong earnings really drive long-term performance, making this a positive signal for investors. Technical indicators were also supportive, with all three major indices staying above their 200-day moving average, which is a key signal of market strength. International markets followed suit, with the MSCI EAFE index climbing 5.26% and the MSCI Emerging Markets Index rising a 1.81%. A weakening US dollar helped boost these foreign markets, though technical trends were mixed for emerging markets. Turning to fixed income, bonds had a solid start to the year as long-term interest rates fell. The 10-year U.S. Treasury yield declined from 4.79 mid-month to 4.58 at the end of January, which boosted bond prices. The Bloomberg Barclays Aggregate Index posted a 0.53% gain. The Federal Reserve met in January and, as expected, held short-term interest rates steady. Markets are now anticipating no rate changes until at least July. High-yield bonds also performed well, with the Bloomberg High Yield Index gaining 1.37%. Economic data released in January supported the market's positive momentum. The labor markets remained strong, with 256,000 jobs added in December, which was well above expectations, and the unemployment rate dropped from 4.1%, to 4.1%, which indicates a steady job growth. Consumers' spending was a bright spot to close 2024, with December personal spending up 0.7%, the strongest monthly gain since March. And meanwhile, GDP growth for the fourth quarter came in at 2.3%, a slowdown from the previous quarters, but still very solid. Importantly, personal consumption, which drives the bulk of economic activity, grew at an annualized rate of 4.2%, showing resilience in consumer demand. Despite this strong start to the year, investors really should be mindful of potential risk. Domestically, policy uncertainty remains a concern. The proposed tariffs on Canada, Mexico, China in early February briefly unsettled markets, and further shifts in trade policy could introduce volatility. Geopolitical risks also persist. Conflicts in Ukraine and the Middle East, along with potential retaliatory tariffs, could create additional headwinds. While these factors haven't had a major impact on the U.S. market so far, they remain important to make sure we continue to monitor them. So looking ahead, we can remain cautiously optimistic. There's been strong earnings growth, a healthy labor market, and resilient consumer spending, which are providing a solid foundation for continued market appreciation. However, policy-driven uncertainty could lead to short-term market fluctuations. So in these certain times, maintaining a well-diversified portfolio aligned with your financial goals is still the best approach. If you have concerns, I encourage you to reach out to discuss your financial plan with your advisor. So in summary, January was a lot of positive momentum in the markets, supported by strong fundamentals and a resilient economy. And while risks remain, the overall outlook is still very constructive. Thank you for your time today, and please don't hesitate to reach out to us if you have any questions.